as a marketer, that's like, if you're not into data, what are you doing? It should be data driven. So I'm very much similar to you, but from an origination standpoint, right? The marketing analytics kind of stop at the point of pre-approval. So I'm curious what you feel are the most relevant data points that people need to have their eye on.
Yeah. So for me, if I was an originator, I would be focused on kind of, and we do long-term envision to put this in the platform, but it's very, very, very expensive, is all that market-driven analytics. So, the companies like MMI out there. Then you've also have My Home IQ is just, I think this month or last month, they're launching their intelligence platform where you can literally log in, identify a loan officer or a agent. It breaks down your 5-year history with them. It'll identify, additional opportunities. It can certainly help from a marketing aspect. And then for the broker owner side of things, it's really measuring all of the, like, where can you improve in your business? Like, can you easily measure how fast you're closing loans outside of UWM, because they do it for you? Be able to filter that by lender. Like, how fast are we closing with this lender? How fast are we closing with that lender? Which of my loan officers are slow and which ones are fast? Which ones are profitable? Which ones are not? Like, can you really easily, without a lot of work, be able to measure all of this stuff within seconds?
I'd be curious if,
and I would venture to say that 99% of broker shops cannot do that.
I'd be curious in your experience, and maybe this is something you guys are thinking about at EpochOS, or maybe it's something that you have, or I guess maybe you haven't thought about, but I'd imagine there's a strong case to measure profitability per loan type, and even get as granular per loan type per originator, to see really where you're at. Do you feel like there's a sufficient enough variance in profitability for a brokerage per product type to be actually
not really for product type, because if you're a compliant shop, you should have the same margin across the board, because if you don't, you're opening yourself up to an unnecessary amount of risk. If you were a retail shop, obviously that's kind of the dirty little secret of our industry. Subsidize our P&Ls on the backs of veterans and the underserved, is kind of the model. You have a 250, 300 bit margin on conventional, so you can, screw over your government borrowers with 400, 500 bit margins, and it all kind of blends together. In the broker shop, that's not supposed to be possible, and that's why our pricing is typically so much better on government loans than retailers.
That makes sense. Well, so there is a disparagement, though, if somebody, like, let's say you're doing a DPA, right? Like that obviously is going to be a lower margin aisle.
Yeah, exactly. And there's been, like, I know that I believe it's the CFPB put out kind of guidance on that, and they were like, we really don't care. Like, it's technically still a violation of LO comp even on a bond loan to pay less. That being said, seems like pretty much everybody in the company does do it that way. So, it's one of those things where everybody's breaking the law, but it's not enforced.
Well, I mean, they're breaking the law in a way that it sounds like in that situation is good for the consumer. Is that why the CFPB is not really worried about it?
I believe so, yeah. And their focus is really on fair lending type of things. That's why you're seeing all those articles out there with, appraisal bias of, values being lower with minorities than they are with white people, and things like that. Those are the kind of things that they're focused on. You might have heard CFPB's been fighting a mortgage broker from Illinois for like 3-4 years now, because he went on a podcast just like this and said, basically, he basically redlined an entire community
really
on a podcast based on kind of what he said is like personal beliefs, so to speak. They're going after things like that.
Interesting.
They don't seem to care about things like LO comp and other things that I feel like they should be focusing on, but they're not. And then you also have the complication of, what the CFPB wants and then what the states want. And they often don't talk well with each other. So like, a lot of people feel that they're safe to pay their loan officers 1099 because their state doesn't have a stance on it, or they explicitly say that 1099 is okay, completely disregarding that you could be violating federal law. And who I'm most scared of is the IRS,
right?
At the end of the day, because if you're not meeting the IRS's definition of an independent contractor, you're not an independent contractor.
Right.
And that is a very fast way going out of business as a mortgage brokerage. And there's precedent for that as well. It's happened in the past. And armed with their 87,000 new agents or whatever,